Welcome to The Explainer. Your 20s are so often called the decade of discovery. You're out there figuring out your career, navigating relationships, and really just setting your life goals. But it is also the ultimate decade to build a lasting financial blueprint. Seriously, the habits you start right now, today, are absolutely going to dictate your financial freedom, your security, and your overall lifestyle for decades to come. So to get us from living paycheck to paycheck to absolute financial empowerment, here is our exact agenda for today. First, we'll look at the power of time. Second, changing your money mindset. Third, building a solid foundation. Fourth, investing early and often. Fifth, accelerating your income. And finally, playing the long game. Okay, let's dive right into this with Section 1, the power of time. When you're in your 20s, you have this magical resource that wealthy 60-year-olds would gladly pay millions to get back, and that's time. Time is the one resource that simply cannot be replaced. But here's the secret. When you combine time with your money, you unlock compound growth. Basically, this happens when your investments generate returns, and then those returns start generating their own returns over time. It's literally like a giant snowball rolling down a hill, gathering more and more snow. You aren't just earning money on your initial investment, you're actually earning money on the money your money made. This incredible mechanism does the heavy lifting for your wealth year after year, and the longer you let it run, the more powerful it gets. And this brilliantly illustrates exactly what I mean. Imagine two totally different futures. On one side, we have an investor who takes early action at age 22. On the other side, an investor who waits just 10 years, starting at age 32 to play catch-up. Well, because of compound growth, that 22-year-old is going to accumulate considerably more wealth over the decades, even if the 32-year-old ultimately contributes much larger amounts of money each month later on. The math is undeniable here. Extra years of growth will almost always beat out larger, later contributions. Now, you might be thinking, okay, but I don't earn a massive salary yet, so how can I even start? Well, you don't need one. $300 a month, which, let's be real, is roughly what a lot of people spend on streaming subscriptions and weekend takeout, can actually set you up for an incredibly wealthy future if you start at age 22 and just automate it consistently. You do not need to be a millionaire to start building significant wealth. You just need to be super consistent with what you have right now. Moving right along to Section 2, changing your money mindset. Because before you can physically build wealth, you really have to mentally build it. Riches don't start in your bank account, they start entirely in how you think about your money. Just consider the contrast between these two earners. Society tells us that the person making $250,000 a year is the wealthy one, right? But if that high earner has a consumption mindset and spends every single dollar they make on constantly upgrading their lifestyle, their net worth stays sitting at zero. Compare that to the person with an ownership mindset, earning a modest $60,000 a year, but who saves and invests consistently. Over time, that frugal saver becomes vastly wealthier than the high-earning spender. It goes to show, wealth is determined by what you keep and grow, not just the raw number on your paycheck. So, to make that massive shift from a consumption mindset to an ownership mindset, you absolutely have to understand the critical difference between assets and liabilities. Successful individuals view money as a tool to buy assets. We're talking about things like stocks, real estate, index funds, or businesses that appreciate in value and actually pay you income. Liabilities, on the flip side, are those expensive consumer purchases. Think of that brand new luxury car that loses a huge chunk of its value the second its tires hit the pavement outside the dealership. To build wealth, you honestly just have to obsess over acquiring assets. Let's shift gears to Section 3, building a solid foundation. Think of wealth kind of like building a house. You literally cannot put a heavy, beautiful roof on a cracked foundation. Before you even get into aggressive investing, you need some structural concrete. Step 1 to pouring that concrete, saving 3 to 6 months of essential living expenses in a highly accessible emergency fund. Keep in mind, this isn't investment money. This is your financial oxygen mask. Step 2 is to completely eliminate high-interest consumer debt. And Step 3, budget by paying yourself first. The very moment your paycheck hits, your savings and investments should automatically transfer out before you can even think about spending them. And hey, these concepts shouldn't feel restrictive at all. They're designed to put you totally in control. Now, I want to be really clear about something here. Not all debt is evil. Productive debt, like a reasonable student loan, an affordable mortgage, or a smart business loan, can actually help build your future and increase your net worth. But destructive debt, and I'm specifically talking about high-interest credit cards here, will absolutely destroy your wealth accumulation. Think about it. If your credit card is charging you 24% interest, there is no safe investment in the stock market that's going to reliably outpace that. You've got to pay that destructive debt off aggressively. All right, bringing us to Section 4, investing early and often. A lot of people are super intimidated by investing. They think they need to be Wall Street experts or have thousands of dollars just to get past the gatekeepers. But honestly, you don't need to pick individual stocks to win. In fact, most professionals can't even do that successfully. Instead, you should focus on beginner-friendly tools like broad market index funds and exchange-traded funds, or ETFs. These tools allow anyone to effortlessly own tiny slices of hundreds or even thousands of companies all at once through just a single investment. This massive diversification massively reduces your risk. Pair these funds with automated monthly contributions and boom, your wealth just starts building itself in the background while you go out and live your life. And as you do start investing, just remember this golden rule. Focus on consistency rather than perfection. You're going to see the market go up, and you're definitely going to see it go down. There will be recessions and there will be boom times. Successfully weathering those market declines is all about relying on your automated habits and your discipline. It is never, ever about perfectly timing the market. Just keep contributing, rain or shine. Let's move to Section 5 and see how this all builds, accelerating your income. Okay, so controlling your expenses and investing automatically is fantastic, but there is a limit to how much you can realistically cut your budget, right? However, there is absolutely no limit to how much you can earn. Scaling your wealth dramatically means boosting your earning power, and your 20s are the absolute best time to invest heavily in yourself. Mastering high-demand skills, things like software development, artificial intelligence, digital marketing, sales, finance, cybersecurity, and project management, will produce returns that far exceed traditional investments. Taking courses in networking to learn these exact skills dramatically increases your baseline income potential year after year. Now, as your income goes up, I want to offer a very warm but very serious caution here. Avoid lifestyle inflation. It is so tempting, right? You get that big promotion, and immediately you want to sign a lease on a bigger apartment or finance a shiny luxury vehicle. But wealthy individuals do the exact opposite. They keep their expenses relatively modest, and they take all that new extra income from their raise and funnel it directly into their investments. That discipline right there, that's the secret to quiet, massive wealth accumulation. And alongside increasing your main salary, you should absolutely cultivate secondary income sources. Creating multiple streams of income, like dividend-paying investments, rental properties, maybe an online business, freelance consulting, or even content creation, means you aren't relying entirely on a single paycheck. This completely protects you from economic downturns, sudden layoffs, or company restructuring. It creates total financial resilience and really speeds up your journey to financial freedom. Finally, we reach Section 6, playing the long game. Look, building wealth in your 20s isn't a get-rich-quick scheme, it's a get-rich-surely scheme. And that requires an incredible amount of patience. Through all the inevitable ups and downs of the economy, never forget that the absolute most valuable asset you own is your ability to generate future income. Market crashes might temporarily lower your portfolio's value, sure, but unlike material goods, your education, your health, your professional relationships, and your skills can never be taken away from you. Cultivate those, protect those, and you will always be able to generate wealth. So the crucial point here is perfectly summarized by this really powerful quote directly from our source material. The financial choices you make today will shape your opportunities decades from now. Every single dollar you invest, every piece of destructive debt you avoid, and every new skill you master is essentially a brick laid down on the path toward your total financial independence. Which leaves us with one final, incredibly important question for you to answer today. What financial choice will you make today that your future self will thank you for? Are you going to set up that $300 automated transfer? Will you start learning a new high-demand skill? The time is entirely yours, the blueprint is right in front of you, and the responsibility is in your hands. Thank you so much for joining me on this explainer. Get out there, start building, and I will see you next time.